What can a $1 error really cost you? Have you thought about that? For one company I worked with, it costed them over $10 million. So I know what you're thinking. No, there was no fraud. There was no catastrophic system failure. It was how their ERP was set up. And how can you make sure your company doesn't get blindsided by the same mistake? So put this video on pause, get yourself your favorite beverage, and let's get into the details. But before we get into the issue itself, let's discuss the impact. Besides the financial loss, which was obvious, there is a reputational damage and sometimes even regulatory and civil cases. Hi, I'm Noel Benjamin DeCosta. I've spent over 20 years helping companies from small manufacturers to governments and Fortune 500s find value that's buried inside their system. I've been a CIO. I've led transformation across 10 different industries. I've consolidated 15 ERP systems into one, modernized finance, HR, and procurement processes, and saved companies over $700 million by fixing how they use their enterprise technology. In my implementations, the ERP is not a shelving cabinet. It brings the business to life. And this particular situation is one of the most quiet and expensive problems that I've ever seen. Let's go into the situation. So I'll give you a little bit of a background. A large manufacturing group based out of the Midwest, multiple entities, thousands of suppliers, and they had an SAP backend. So the finance was closing year-end books. Everything looked fine on the surface, no red flags. Then a line item popped up. A purchase order slightly overpaid at $1.17. Seems harmless, right? That small mismatch didn't trigger a warning. In fact, it didn't trigger anything. And you might ask why? Because the ERP system, and most of them have this, had tolerances built in. It was configured to ignore anything under $2 per line item. And this was happening thousands of times across departments, across entities, across multiple currencies. And if you've seen something like this, comment below curious and we can have a chat. Now the question is, does this really happen in SAP? Stay till the end as I'll show you how you can check this in your own company and systems. Well, in SAP systems, especially in the or material management and FI, financial accounting, it allows for tolerance settings to be configured at multiple levels. You can do it per line item or document, per vendor or purchasing group, by currency, by percentage, or fixed value. And just as an example, it was $2. These settings are allowed to allow small differences between purchase order values, goods receipts, and invoice receipts. If the difference between these documents fall within the allowed tolerance, the system will not block the invoice. It just posts it automatically. This is governed by configuration settings like transaction, OMR 6 for invoice tolerances, and my SAP colleagues will know about this. Tolerance keys like PP or DQ, DW, BD, etc. Here's what most people miss. The system didn't make a mistake at all. It did exactly what it was told to do, but no one questioned the logic behind it. What was flagged as tolerable in a single transaction added up fast. The same rounding rules applied to 2,700 vendors. That $1.17 average discrepancy multiplied across 46,000 invoices over 5 years. And the total leakage was just over $10.2 million. All of it hidden in plain sight. And because it was considered within the tolerance, it never appeared in any exception reports. So the auditors missed it, finance didn't catch it, and IT had no idea. Now, this didn't happen because of one bad decision. It happened because of three systemic failures. Misuse tolerance logic. This is where tolerances were set globally and not by vendor or category or at a risk level. What was reasonable for stationery was applied to heavy equipment. The second one was no cumulative analysis. The system could only flag individual mismatches. It didn't check for patterns over time. And the third systemic failure was process silos. Finance assumed procurement owned it, procurement thought IT had it, and IT was just maintaining the rules that they were given. That's how small gaps become multi-million dollar problems. So once we identified the issue, here's how we fixed it. We applied a tiered tolerance level. Now, what does that mean? So the ERP system had a global tolerance setting. For example, $2 or 1% applied uniformly across all suppliers, categories, and transaction types. That's operationally lazy and financially risky. So, what did we do? We implemented a tiered tolerance matrix, which meant critical spend categories, as an example, heavy equipment, capital procurement, defense related items, had zero or near zero tolerance. The second thing was low risk categories. Examples could be office supplies, maintained small fixed tolerances, but with monthly reviews. And strategic vendors with recurring high volume transactions were reviewed individually and tolerances adjusted based on performance and trust level. So, how did we fix it in SAP? We used tolerance keys in the OMR6 and the OBWL, and we created custom logic by vendor group or material group. And for some categories, added a hard block beyond plus or minus 0.01%. The outcome was reduced auto posting of mismatches by 76% in high risk categories and forced exception workflows for review. So the second thing that we did was pattern recognition using machine learning. So the problem, as we all know, was the ERP could flag an individual mismatch, but couldn't recognize patterns across time, vendors, or categories. So what did we do is we built a lightweight machine learning model outside the ERP to scan historical invoices, approximately 2 to 3 years of data, flag vendors who consistently billed just under the tolerance limit, and identify clustering patterns. So, as an example, 10 vendors making similar mistakes in the same week, which could potentially lead to, could be a potential collusion or shared process flaws. And then the fourth thing that we did was tag line items that triggered small mismatches repeatedly across quarters. So how do we do this, right? We use Python and TensorFlow with SAP exported data via CDS views or BW and fed the results into SAP Analytics Cloud and created exception lists. And then integrated top flags into ServiceNow workflows for follow-up. So this was then all being done at autopilot. So the outcome was we caught 14 vendors who had over 30 plus within tolerance mismatches in under 6 months, and the recovery and compliance actions followed after that. So the third way that we solved the problem, the major third way, was the process alignment between finance, procurement, and IT. Now, the three core teams operated in silos. Finance didn't question automated tolerances, right? They thought they had it all figured out at the time of the implementation. Procurement assumed mismatches were handled downstream. And IT were just simply maintaining system settings from years ago, when they did the implementation. So what we did was we established a monthly leakage review meeting, which involved the head of procurement, the financial controller, and the ERP functional head. And what we did was Together, as a team, we reviewed the tolerance breach logs, the supplier exception trends, and pending blocks and credit notes. So every tolerance had a clear business owner. The outcome was we reduced the often exceptions by around 90% and also triggered a full review of vendor master data where outdated payment terms and tax mismatches were found. The fourth one, which was the most important because it kind of set the right precedence for the future, was real time dashboard showing a cumulative impact. So the problem was standard ERP reports only showed individual mismatches. They don't aggregate small errors into a financial picture that matters. So what we did was we built real-time dashboards showing the monthly cumulative variance by vendors, repeat mismatches across entity or category, and leakage heat maps by material groups or plants. We use SAP Analytics Cloud to pull the data via BW queries, and then this flagged trends in dollars and the local currency, not just the document count, which shifted the attention of the executives. And the key metrics we tracked: total mismatch value per vendor per month, the average variance per invoice, and the percentage of invoices with recurring issues. The last one, which was critical, was tolerance breaches versus accepted postings. Why? Because this gave the CFOs and the controllers financial level visibility, not just IT level logs. And it helped drive vendor renegotiations and internal compliance changes. Within 6 months, they recovered $4 million in overpayments through credit notes, claim offsets, and supply corrections. The rest of it was lost forever. But the lesson was clear. Your systems don't need to break to bleed money. They just need to stay unexamined. Now, you might think that this is rare, but it's not. In fact, most organizations running ERPs today, whether it's SAP, Oracle, or Dynamics, they all have similar blind spots. Tolerances were set years ago. No one reviewed them. And the reviews should be happening repeatedly, at least once every 6 months, but they don't happen at all. And systems that automate errors at scale. So when you layer on mergers and multiple entities and offshore support and outdated SOPs, no one's really watching the full picture. So who's responsible for catching this? The short answer is everyone. CFOs need better visibility into cumulative variances, not just account level balances. COOs should push for aligned KPIs between the finance and the procurement. And CIOs must ensure system rules reflect real business logic and not outdated assumptions. Internal audit as well plays an important role. They need tools that go beyond sampling. Continuous monitoring tools, they are quite prevalent today, is the need of the hour. As an auditor in my previous life, this is where the value is shown. So this is exactly where AI, automated controls, and real-time monitoring can be used well to establish transparency and accountability. So if you're running your ERP today, ask your team these 5 very, very important questions. What's our tolerance logic, and when was it last reviewed? Can we track small variances cumulatively over time? Are exception reports reviewed by the right people monthly? Do we audit vendor-level mismatch patterns? And who actually owns these configurations? And is that ownership clear? No one can answer these questions. You have a silent leak happening right now, and the longer it runs, the more it costs you money. So that $1 error wasn't just a technology failure, it was a leadership blind spot. Your ERP is as good as the logic that you build into it and the people you assign to watch over it. If you're tired of systems costing you more than they save, this channel is for you. Subscribe for weekly breakdowns like this. And if you're the one responsible for cleaning up the mess after the fact, start with this video. It talks about how one company beat its competitors with nothing but clean data. I'm Noel Benjamin DeCosta. Thanks for watching, and I'll see you in the next one.